Ladies and gentlemen, good day and welcome to the KPMG in India's webinar on UAE Economic Substance Regulations. As a reminder, all participants' lines will be in the listen-only mode. During the course of presentation, if any participant intends to ask questions, you can do that by writing questions in the question box appearing on your screen. All questions will be taken up at the end of the session. Please note that this conference is being recorded. We'll wait for another 1 minute for participants to join. Thank you. Thank you everyone for joining. I now hand the conference over to Mr. Himanshu Parekh. Over to you, Himanshu.
Sorry, I guess I was not audible. I hope I'm audible now, Anjali.
Yes, Himanshu, you're audible.
Sorry, my line was muted. Okay, a very good afternoon to everybody and welcome to this session which we are going to have on the substance regulations which have been recently introduced in UAE. Just by way of a backdrop to provide you a brief overview on what this regulation is all about and why has it been introduced in the UAE. We'll need to go back to the year 2017 for this purpose. In December 2017, the European Union Code of Conduct Group essentially assessed the tax policies of several jurisdictions having either no or nominal taxation in their country. And this was to be evaluated against the criterion of economic substance prevailing in those jurisdictions. The criterion stated that a jurisdiction should not facilitate offshore structures or offshore arrangements which are aimed at attracting profits which do not reflect real economic activity happening in that jurisdiction. As a result of this assessment, a list of certain non-cooperative jurisdictions was prepared and was published. And this list included UAE as one of the countries featuring in the list of these non-cooperative jurisdictions. Quickly taking a note of this, UAE sprung into some action. And in April 2019, UAE introduced the economic substance regulations with a view to ensure that it addresses its commitment in relation to the lack of economic substance requirement for doing business in the UAE. With the introduction of these regulations, UAE has now been removed from the EU blacklist in October 2019. So to give us an overview on what these regulations are all about, what do they mean for Indian MNCs having a presence in UAE? I would now like to invite on this webinar Anuj Kapoor and Neha Jain from KPMG UAE, who will take us through the key provisions and practical aspects surrounding these regulations. Just by way of an introduction, Anuj is the lead international tax partner in UAE with extensive experience in international tax, working across tax value chain, international acquisitions, transaction structuring, BEPS, corporate and financial restructuring. Neha is a senior manager with the international tax practice in UAE with a focus on tax and exchange control regulations. So with this background, I'll now hand it over to Anuj to walk us through the salient features of this regulation. What does it mean for Indian MNCs having business operations in UAE, and what kind of compliance requirement would they need to take care of to ensure that they meet the substance regulations in UAE? Over to you, Anuj now.
Thanks, Himanshu. Thank you, everybody, to invest your time today with us on this webinar. And Himanshu has very clearly laid down the background for me to take it forward. I think before we do that, we really want this webinar to be as interactive as possible. So while I will try in the next 30 minutes to not only explain what this means for UAE as a country, more importantly, what this development means for companies established in UAE, we would also like more and more questions as you think in your positions as tax advisors in your relevant organizations or people responsible to take the right tax position. Try and contextualize these regulations specific in your context. We'll welcome questions towards the end of the webinar. And just in order to make it a bit more interesting, we also have some polling questions, which will keep giving us some feedback as to where do you see yourself currently, closer or otherwise to this development and what this means for you. Just to break the ice, I would request the team to put in the first polling question on the screen. This is just a warm-up to help us understand that we are getting the right responses. You're able to use this tool effectively yourself and for the benefit of everybody on the webinar. So please take the next 10, 20 seconds to fill in your responses and submit it. Now, before I move to the next slide, what I would really like is for each one of us to definitely think about UAE as a jurisdiction which even currently has taxation limited to oil and gas companies and banks of branches of foreign banks. But at the same time, it's the same country which has seen in the recent times various things thrown at the international tax professionals. For example, we saw common reporting standards being implemented for financial institutions. We saw FATCA being introduced on the back of US agenda. We saw VAT come into being. We saw customs duty expanding its scope. We saw excise duty coming in. We continue to see more and more governance on many other measures, all of them aimed at one big agenda, which is governance. And since international tax can never escape the larger agenda of governance, economic substance in a way brings about, in my view, probably the biggest renovation of the international tax profile of UAE in the context of G20 countries. And this also swells from the fact that UAE highly depends upon the incoming foreign capital from EU, Asia, Pacific, etc. It sits at a sweet spot both for inbound investments coming into UAE, throughbound investments coming into the UAE, and then UAE being the threshold for investments going in the wider Middle Eastern region as well as the rest of Africa. And also many outbound investments made by UAE homegrown businesses. And many of those investments go into the much more maturer and developed economies for which BEPS, base erosion and profit shifting, has been a very high agenda. So with this context, I'll request the team to move on to the first slide and really also request the polling results to be shared with the panelists. Now, as Himanshu rightly mentioned, the response from UAE was as a result of the OECD measures. Closer to home, we all are aware that Saudi Arabia is a G20 country, and within GCC, knowing the brotherhood amongst the GCC countries, while UAE is not a direct BEPS member, it's what we call as a BEPS associate member. The obligation falls squarely on UAE to commit to the minimum of minimum 4 out of 15 BEPS action plan, and this is where action 5, which is on economic substance, comes into being. Now, what's important to note is that this far, the regulatory and the legislative framework of UAE has broadly been determined by the mainland authorities, the free trade zone authorities, as we all are popularly aware of, and of course, certain other regulators for certain specific sectors, such as Reserve Bank for banks, Insurance Authority for the insurance sector, so on and so forth. However, none of these licenses, operations, and the legislative framework has an impact on the economic substance regulations, because economic substance regulations is an overarching concept which escapes and which is a superimposing law over and above the company law or the licensing law of UAE as a federal. As one would imagine, the commitments have been made at the highest level, and the OECD Code of Conduct Committee is the final authority which decides the application, the efficiency in the application, and the ongoing governance of the economic substance rules, which means the application is far and wide. Other than really a government-owned entity, and there is a clear definition of what a government-owned entity means, there is no other exception really to suggest, there's no real revenue threshold to suggest an exclusion from the application of economic substance rules, unless you make an informed decision that going through the analysis of the entire provisions, your specific UAE outfit may or may not fall within the 4 walls of ESR regulation. So it has to be a much informed decision. Expressly, there is no exemption from the application of these rules. Now, the requirements, and we will go through specifically the filing requirements as well as how do you go about embracing this new law, specifically in the first year, 2020 being the first year of compliance. As most of us might have experienced, any new law, specifically in the Middle East, takes the toll of heavy lifting in the first year. There is a fine tuning to be done on the commercial side, on the operational side, on making sure that the impact is neither overestimated nor underestimated. And accordingly, you are in good hands to undoubtedly take a position on where do you fall in terms of your economic activities within the UAE. There is also a clear mechanism, thankfully defined, as to who becomes the regulatory authority for each and every entity. This has been categorically done since the compliance for these regulations has to be met at each entity level. Whether it's a branch, whether it's a rep office, whether it's an LLC, mainland or free zone, irrespective, for each entity, you will have to pick that entity on its standalone basis, apply the regulations, contextualize it, and accordingly determine your compliance obligation. Moving on to the next slide and requesting the team to present the second polling question for the audience. And this really determines and indicates how far UAE has come as a country on the roadmap of not only first being blacklisted, adhering and trying to embrace the implications of what it would mean for a zero tax jurisdiction to embrace substance requirements. The data is self-explanatory, but I find it very useful to share this with our clients, more so because not many and most of these activities find their spot in the day-to-day press releases or newspapers, specifically in the Middle East. Also, if I can take the liberty of saying that there has to be a good balance between embracing new regulations such as these, and also from a practical standpoint, not letting go of your competitive advantage. But this is the route and the distance covered by UAE as a federal. In absence of a clear tax administrative framework, other than FTA, which handles the VAT matters this far, and it's hardly It's less than 3 years old. As a tax professional sitting in house within UAE for more than 7 years now, it does appear to be a path taken with a lot of effort, a lot of commitments, and a lot of resources being dedicated. And that shows the importance of these regulations. Requesting the team to share the results of the poll, and this really should give us a good perspective as to where do you see yourself at a distance or close to really understanding what these regulations mean to you up personal. While we wait for the results, moving on to the next slide. Now, this slide, for the benefit of all our audience, specifically to discuss this economic substance regulations with someone which may not clearly have an international tax background, and also, UAE as a country has a perception of being a tax-free country, which, as I mentioned in my introduction, has fairly changed from where it started back in time. But this slide really summarizes how one should go about determining the application and the notification or the return compliance requirements for entity by entity in your structure. So if I move from the left-hand side of the slide, given the answers being yes or no based on your respective situation, you would end up resulting in definitely being subject to the first compliance of ESR, which is filing a notification. The idea here is, if you pick up your trade license, if you pick up your audited financial statements, or even the management reports, if you pick up your VAT profile, because that's the only other opportunity you have had to take a tax position in UAE, there being no other tax for majority of the audience. These 3 data points need to then be stitched together to the 9 activities listed in the dotted box in the slide. Whether you fall within one of those one of those activities, maybe you fall in more than one, or for a very valid reason, you may fall in none of those activities. In either situation, you will end up notifying your regulatory authority that whether your position is a positive notification that yes, you do fall under these relevant activities, or it is on the negative side, and hence this is your last compliance and you will not continue with any further compliance since you are out of scope. Which means it's pretty clear in every circumstance, other than a government entity, you will have to make this analysis. You will have to marry the facts to the OECD narrative as well as the ESR local regulations, and take an informed view as to where do you fall within those 9 listed activities. There's no going back. Once a notification goes in, the regulated authority will be automatically ready for you to comply on the next step based on your notification submission. Now, it's very, very important to note that these 9 activities do not necessarily coincide with the trade license you might be issued, because the trade license is a commercial element and these activities have specific definitions, they have specific connotations, specific examples, and the intention is very clear from OECD that by dint of these activities, based on their study of the economic texture within Dubai, within UAE, they expect that majority of the entities should fall in some or the other compliance requirements of ESR. Now, going forward, and we will also discuss this in the slides to come, there will definitely be a requirement to assess whether you satisfy all the conditions of economic substance, or there is some gaps which are identified, and what measures you can take to make sure that those gaps are either immaterial, and on the other side, if there are material, are there any alternative strategies you need to adopt to make good the gap. Ultimately, you will end up filing your annual economic substance return with your regulated authority. From there on, hopefully, unless there's a change in the business model, you would see this becoming an annual compliance on a year-on-year basis. Now, a very popular question which comes to me is, Anuj, we are in UAE, we are no tax. If this is really coming to being, are there any penalties? What is the cost of non-compliance? And other than the penalties, and I draw your attention to the left-hand side bottom red font where we have failure to comply mentioned. What's important is, to me as a professional, the biggest risk is the non-renewal of your trade license. Whether we like it or not, this is where not having any other tax within UAE impacts the axe fall straight away on the day-to-day operations of your entity, and any renewal which you seek on an annual basis ordinarily will depend upon whether you have successfully and satisfactorily complied with the ESR regulations. And the other element is the automatic exchange of information which gets triggered on violation of these rules, which means whether it's about exchanging your files and data with the Indian tax officer, any other non-UAE jurisdictional tax officer where you might have parallel presence, it becomes the discretion of the regulatory authority to ensure that the data for the non-compliant entities is freely exchanged, of course, on demand from the non-UAE side of authorities. Now, moving on to the next slide. Now, I said a lot about regulatory authorities, and I also mentioned that while the mandate was started by the Ministry of Finance, as one would have expected, the responsibilities were soon delegated to the respective regulatory authorities, which for free zone entities become the respective free zone in which you are set up. These are some of the dates for notification for the financial year ended 2019, which have been already announced. Mind you, on the back of the COVID situation, these dates were not as they are. Some of them were 31st of March, some of them were in the first week of May. And as a response to the COVID situation, the regulatory authorities have been empathetic and trying to delay the notification submission. But the important thing here again is the final compliance of ESR is to be completed by 31st of December 2020. The notification as a semi-compliance has come into being only in countries such as UAE, and probably logically thinking, this gives the regulatory authority some time to really assess based on the notifications as to what is the quantum of data, what are the number of companies which will be throwing an additional report towards the regulatory authorities, which they really need to take onus of, right? They need to start preparing the systems, whether IT or manually, and have the right talent to comprehend this data and be ready to take the battle. Now, even if certain free zones which are missing here, even if for the mainland authorities, which the Ministry of Economy has not specifically mentioned a due date for notification, the clear announcement has been that please start complying with the notification effective 1st of January 2020, which means they have opened the door. Logically speaking, if you move backwards from 31st of December, there has to be a reasonable gap for this notification mandate to be meaningful for the recipient regulatory authorities, and hence we do not expect much more delays beyond, say, 31st of July in majority of the situations. We are also working with some of these free zones to make sure they are ready, and the sentiments are pretty similar. Now, moving on to the next slide and requesting the team to also show the last polling question which we had for our audience. Now, these are some of the very popular, as I see, and I've spent fair amount of time being on the Indian side of affairs with KPMG, and if I can take the liberty of saying that it helps to see the situations on both the sides of the table. We felt that for the purpose of this audience, these would be the relevant activities amongst the total 9 activities where significant amount of our audience here would tend to get covered. Again, picking on the distribution and services business activity, the one really needs to look at these activities not by the nomenclature, but really what is the intention. The intention is if by dint of engaging in any of these functions, there is a revenue or a margin being booked at the UAE level, then within the group, this UAE entity needs to, for the first time, substantiate whether it truly deserves to earn these revenue and margins, which means, does it necessarily have the men, material, labor, resources at play within the country which are capable enough and are in consonance with the level of economic profits which the activity is generating and booking within UAE. If you are successful in substantiating this, you have automatically substantiated that this specific UAE entity in my example has not contributed towards PEPs, has not contributed towards eroding any other country's taxable base, has not contributed in shifting of economic profits which actually belong to any other country, because the economic profits very much belong to the UAE as a federal. Holding company, IP business, and we also have some case studies. I'm also conscious of time. We have these case studies to really show that over and above the names of these activities, one really needs to seriously give due considerations, and hence the way we are analyzing the application of each activity for our clients, the first question to ask is why I should not fall within this activity and not the other way around. So if you keep proving your negative in each of these activities, that maybe I do not fall under distribution, I do not fall under holding, as a residual of that analysis, you will reach a conclusion that which will prove that without doubt, and because of the reasons mentioned for not falling under n number of other activities, as a undoubted conclusion, either you fall in one activity or more activities, or you are outside the scope. In any case, the phase one of your analysis is very crucial to fully take an informed decision, more so in the first year, which you will be defending on years, as to where exactly can somebody plot you and why there is no other argument to the contrary before classifying you in any of these activities. Now, moving on to the next slide. Now, distribution centers, and this is a fairly common structure which we have seen over time. And by all means, I can request the audience to look at the UAE box as an LLC or a branch, irrespective. For UAE purposes, there has been, while legally we all are aware that branch is not a separate legal entity but a mere extension. But for economic substance purposes, even a branch has been categorically been dealt with as a separate legal entity for all practical purposes. Now, in this situation where you import goods worth 100 in UAE and load a margin of 50, whether you deal with the Middle Eastern customers locally or you end up re-exporting it outside UAE, which is also a very common example, specifically when it comes to free trade zone operations. The question is whether you fall within the distribution and service center. In fact, the obvious answer here is this is exactly the core of why this distribution and service category of economic activity has been created within the regulations. You need to substantiate that why the UAE outfit deserves the margin of 50. Moving to the next case study. Service centers, and this is again a very common structure where you might have an entity in UAE which for your Middle Eastern operations does, either it's a shared service center or ends up, because of the access to talent, because of the access to various other commercial ease of doing business, ends up with costs which are taken on board as a common costs allocated then to the group, including the Indian outfit, and there's a cross charge. Now, whether this activity deserves to be justified and falls within the definition of distribution and service center. So in this scenario, again, the idea is whether there is a margin or not added, whether it is simply a cost recharge. Because of the cost recharge, the Indian outfit, which is taxable, will end up taking a tax deduction in their tax return. And hence, there is an element of a reduced tax liability in India. Even under these circumstances, you will have to justify as to what is UAE so capable of doing that it has to provide these services at a central level and then cross-charge it to India or any other group entities. So again, by these two examples, you will be able to really gather that it has to be a multi-dimensional analysis. It does not really depend upon whether there is a margin or not, whether there's a deemed service, whether there's a deemed consideration. You really need to be 100% sure before the notification goes in as to where does the UAE operation fall under. Moving to the next example, holding company. And this is again for the through-bound investments I mentioned towards the beginning of the webinar. If in your structure a UAE entity is being used as a platform to further do expansion within the Middle East, within UAE itself, or even the rest of the region, and by dint of doing that, you end up having a holding function housed within the UAE entity. But at the same time, in this specific example, what we are trying to cover is it's not a pure holding company, but you also have certain manufacturing operations, because at the end of the day, this is a structure wherein you are in the F&B sector and you're trying to operate certain restaurants. Now, in this situation, what will happen is, of course, if you have a manufacturing setup which is fairly capital intensive, and at the same time you're having full-fledged restaurant operations, and this is where I said, let's not even overestimate at times the application of ESR. Since nobody can question the substance with so much of capital investments already made, in this particular question, while you fall under the holding function definition, by dint of your incremental profile of being a manufacturing outfit and a restaurant operator, you will not fall within the full application of ESR regulations. You will end up most likely filing a negative notification that I so and so, by dint of having this set up, do not fall under any of the 9 activities, and hence kindly forget us. We are not going to comply with any further regulatory requirements. Moving on to the next example, and we continue the holding function in another example. Now, in this situation, if you see, you are a holding company in UAE. You have 2 subsidiaries, as I said, as through-bound investments. You make dividend income and interest income. Giving loans through a UAE outfit is fairly common. Now, what's interesting to note here is the holding company definition under the ESR regulation strictly limits the holding function to be a function wherein the revenue generation is only from passive income, which means either dividends or capital gains. Interestingly, even interest is outside the scope of a holding function. Now, in this situation, while you might have a holding license being issued by one of the free zones, and that's fine, nothing changes there. But from an economic substance perspective, you are not only a holding company, but also a financing company, which means suddenly your profile from an economic substance perspective needs to satisfy the adequacy test and the core income generating test for 2 activities. Now, on the face of it, this might appear to be pretty simple, that you have a holding function and you have dividend income. But and even if I stitch the previous example of cost recharge, there again, you might fall under holding plus financing and service activity for ESR purposes. So again, a very multi-dimensional and dynamic analysis is required before you can take a final position. Moving on to the next slide. Lease finance, and I think this is one of the most debatable, along with IP, and the most interpretative economic activity because of its far-reaching context of the definition. Interestingly, this far, IFRS has been, dominating the positions on lease finance for each and every one of us. Interestingly, within UAE, there is a lease finance law, which also needs to be taken into account before you take any ESR positions along with the IFRS. And then, of course, there are ESR definition of what contains within the lease finance operations. Now, if you see this example, again, there is a treasury function which is housed within the UAE setup. And these, I do appreciate that these kind of structures evolve over time. If you have been within the country, you tend to use your UAE outfit for more and more purposes as possible. Many a times it is driven by the commercials of not exposing yourself to a lot of foreign exchange risks. And these examples have come out actually from live situations we have already faced and commented on for our clients. Now, depending upon the borrowing and the lending profile of the UAE and its relationship with subsidiaries, in this situation, from a lease financing perspective, you will have to again substantiate as to why UAE is sitting in a sweet spot where it not only has access to the funds at 4%, while it can deploy it. And many a times we do see that cost to cost deployment of funds happens on the premise that I'm a holding company and I want to take care of my subsidiaries. But irrespective of a margin being loaded on the borrowing versus lending rate, your economic activity and the fact that you're still making some interest income is being generated in your UAE outfit, you will end up having to comply with the economic substance requirements as if you are in a lease finance activity. And this may have no relationship to your actual commercial license issued by the mainland or the free zone authorities. Moving on to the next example. Again, in this situation, you are in a business probably, or you are facilitating sale or supply of office space. This is the commercial lease side of business. While in the ordinary course of business, you will definitely have the payment terms, credit terms agreed with various customers. These customers, of course, are third-party customers. There's no related party element here. Now, in this situation, what will happen is your UAE entity, while it has all the commercial licenses issued to it in the first place, this is not really construed on its independent basis. And I'm saying this on the assumption that there is no other element of economic activity. There's no contamination of any other activity. This is the sole activity undertaken by this UAE company in question. Since this company is more in facilitating business, in the course of doing your regular business, you end up facilitating your customers with the supply of commercial leases. This is not considered as an economic activity from a lease finance basis. But if there are other elements to it, then you will end up justifying your economic substance for those other elements. So again, not everything you do. So this is probably an example on the commercial side closest to qualifying as lease finance. But from an ESR perspective, it's quite the contrary. Moving on to the next example. IP business, and whether it's our friends from F&B, from retail, from various other corners, if you end up setting up a UAE company which becomes a sub-franchisee or a sub-licensee of a brand, of an IP, which is again used in your through-bound structures across the Middle East, by dint of which UAE outfit ends up generating revenues from this IP function, then in this scenario, the moot question which OECD wants an answer to is that as an entity in UAE, what kind of economic activities have you actually undertaken to call yourself as a beneficial recipient of an IP income? Or is it a cute way of, again, promoting BEPS? You are trying to collate and pool the revenues coming from IP at the UAE level, whether by way of deferring your Indian taxes or any other global taxes in a broader structure. The question is really the UAE has to determine and substantiate the functions, the risks, the expenditure, the actual day-to-day operations which enable UAE to make the to receive the beneficial income coming from the use of IP. And we feel this IP element is something which will keep on being more and more thinly spread. We see more and more applications in course of the FAQs, in course of additional guidance being by Ministry of Finance. Both lease finance and IP structures would definitely be the ones which will be, targeted and at the sweet spot for the application of economic substance rules. So one really needs to be very careful in any of these sensitive structures. Moving to the next slide, and conscious of time. And yeah, so I think these are some good food for thoughts we thought we'll share with you. Not every regulation is perfect in its first year of implementation. More so, there is a learning curve for the ministries here, for the free zones here, to really understand and keep coming up with more and more clarifications of questions such as drop shipment, which literally covers a majority of trading operations in UAE. If one looks at it from substance over form, whether the goods actually come into UAE and are stored in UAE is relevant, or whether just the booking of revenue and margins in the UAE outfit are good enough reasons to trigger the economic substance regulations. These are certain gray areas which have not been specifically dealt with, but as you would expect, the regulations are new. We need to draw inferences from the OECD narrative and also draw inferences from what other countries, which are ahead of the curve in implementing these regulations as compared to UAE, have successfully adopted a position on these matters, and the ones which have landed successfully and acceptable to the Code of Conduct Committee at the OECD. Head office branch operations, again, services to the head office. These are really those interesting gray areas which come to life in a very peculiar position. So there cannot be a generic position adopted on these matters. And as I keep telling, this is a multi-dimensional analysis. One should not be taking a single dimensional view based on one single fact pattern. Moving on to the next slide. Okay, great. So this was my gig on economic substance. I hope these practical examples do try and make you think of how to contextualize this in your specific situation. Over to the operator back for any Q&As coming from the audience.
Thanks, Anuj, Anish here for your excellent insight about the UAE economic substance requirement regulation. Anuj, we have lots and lots of questions for you. We'll try to cover maximum over next 15 to 20 minutes. 20 minutes. Rest of the question then will be replied on a one-on-one basis. So Anuj, here is the first question for you from the participant. He's asking that we are just registering a holding company in DMCC. When does this ESR provision to have a local management starts, and how much time they have once company is registered?
Thanks, Anish. So as of now, for financial year 2020, we are looking at compliance for the entities which were in existence last year. For any new entities coming up, we expect the free zone authorities to upskill and upgrade their onboarding policies themselves to ensure that the right questions are asked and the right conditions are put in at the inception stage itself. Now, I'm conscious that the free zones are still on a learning curve. We are only working with a handful of them up close and personal. So as of now, probably they will ask certain questions on your business plan, which also under the standard procedure you need to submit. But for any new company coming into being from here on, the actual compliance to ESR will only commence next year.
Okay, thanks Anuj for that. The second question is that UAE company is held by an Indian shareholder. UAE company is a manufacturing company, hence substance already exists there. However, if UAE company also has some operating subsidiaries in other countries, is this regulation applicable on UAE company and hence required to file notification?
Good question, and I'll answer it as follows. There is something called a full compliance to ESR and something called a partial compliance. Nobody other than government entity escapes the partial compliance to ESR, which means yes, you have a manufacturing setup. Yes, nobody can question the substance in a factory standing tall in UAE. But if you have holding company functions, you need to undertake the analysis of whether you fall under the holding function or not, and then determine whether you file the positive notification or a negative notification. In majority free trade zone regulatory bodies, they are of the view that they want every entity set up within the free zone to at least file the notification, even if it is negative.
Okay, great. That gives lots of clarity to the participant. Anuj, the next question is whether all constituents entities reported in CBCR notification under UAE should file notification in ESR.
So, in a way, the CBCR and ESR are not related on the compliance mandate. CBCR had a different purpose. ESR needs to be assessed entity by entity in any case. Of course, if you have an entity which has filed a CBCR notification, there is another trail you have created and informed UAE that you are a part of a larger group and you are filing CBCR in your home country wherever you are consolidating your reports, which means that UAE is sitting as a line item in your CBCR report filed in your home country. Now that information needs to absolutely corroborate to your ESR filings. Any deviations will lead to consequences, and you will need to really substantiate as to why there is even a 1 dirham of mismatch between your ESR filings locally here and the UAE line item forming part of your CBCR regulations.
Okay, that sounds great. The next question from the participant Anuj is, does the relevant activity to be determined solely based on the activities laid down in the trade license? And the next question continuation to that is, what happens after filing ESR?
So I'll take the first question. Now, your trade license has two informations. One is what license have you been given, say a trading, general trading, holding, and then what activities under that license have you been approved of. That is only and only a data point in determining your ultimate ESR obligation. The qualification under the 9 activities has to be driven by the definition and the expansive FAQs and the relevant activity guides issued by Ministry of Finance. The license is only a data point. So you have to marry the two, but you cannot take a position merely on your trade license. The second question on ESR, what happens? So once you file the notification, the regulatory authorities get an alert that so many entities will have qualified within, so many entities haven't. In a way, it gives UAE a good data to go to OECD and flag that, see, this in, by dint of these notifications, 90% of our entities in UAE have said they will self-policingly comply with ESR regulations. After that, you file your economic substance return. The statute of limitation is 6 years, which means once you file your return on 31st December 2020 latest, till 2026, your file is open. If there is any reason for non-compliance, any reason where your non-UAE related tax officer cannot understand or comprehend your ESR filings, and there is a mismatch or any amount of non-matching of tax data, there will be consequences which will come on UAE first as a federal, because they have given the commitment, but they will easily be the postman and fall back on the regulatory authorities, either the free zone or the mainland, and ultimately the risk is on you to go and justify before any court that why there was a mismatch between the two filings. And this is one of the main reasons why dispute resolution is also one of the minimum for BEPS action plan. We expect a lot of litigation going forward if the data is not correctly submitted or comprehended.
Okay, great, Anuj, that's great. Good to know about that. Very interesting question, Anuj, for you. the participant is asking that does ESR effectively put an end to forming companies in UAE to eliminate profits, and how does this make UAE in tax planning?
Right, and again, a fairly intelligent question and also a common one we receive. So I've been around in UAE since about more than 7 years now, and I've only seen the governance profile of UAE go north. Now, I also end up dealing with a lot of corridors with EU, Asia Pacific, and every time a governance framework comes in, there is a set of set of companies who like the fact that once UAE itself shines itself on high standards on tax governance, on accounting governance, on anti-money laundering, on IP related security provisions, XYZ, then nobody looks at the overall structure with any doubt, apprehension, or a question, simply because there is a UAE in the flowchart. And that itself puts UAE in a strong footing, similar to what a Singapore is to Asia Pacific, if I was to just make a broad comparison, that we are here to facilitate business. We are here to make sure that the Middle East can be catered by being a base at UAE level. We are here to make sure that the governance standards are absolutely G20 standards, and nobody should have a question mark on the quality and the substance within UAE being, as again, part of the larger scheme of events. Now, this leads to a very positive profile of UAE in the long-term, larger context of things. But every change brings in some pain. Whether it's a good pain or bad pain, of course, can be circumstantial. There'll definitely be in the first year an incremental cost of compliance. But just imagine once you are fitter, right? Once you have a higher stamina, you would be going for a long-term run, and that is what the overall positive outlook is towards UAE. I hope that answers the question. Anish, you're on mute, I think.
Okay, sorry. The next question is, Indian company selling goods to Dubai company under build to ship to model. The goods does not physically enter UAE. Dubai company has a relevant people to carry out operations, whether such activities fall under distribution and services business.
Right, and I did try to cover this in the drop shipment example I used. So the question you need to ask yourself is, am I booking profits in UAE irrespective of the movement of goods? Am I booking revenue in UAE irrespective of movement of goods? Are those revenues and margins escaping taxation in any other country irrespective of movement of goods? If the answer is yes, then from a substance over form perspective, and mind you, the mandate from OECD is maximum compliance, you would end up taking a position that for all practical purposes, I fall under distribution and services, unless you have some very good reasons to exclude yourself. Now, the FAQs and the activity guidelines are only becoming more and more broad-based, more and more thinly spread to ensure maximum compliance. Again, I'll repeat my comment. The question should be why I should not fall under distribution and service. You will get your answer. So in more likely scenario than not, you will qualify.
Okay, great. That's good. Anuj, there are a couple of very generic points. What do you think? Do you expect that FZEs will provide extension in deadline for the ESR notification filing, considering the present COVID situation?
Right, and I'll answer that as follows. The law comes into effect April 2019 for everyone, for mainland free zone customers, companies, advisors, everyone. Second, the first set of deadlines came out starting 1st June 2020. Then it was cascaded to 31st of March. Then now it has been cascaded to 30th of June. The understanding with OECD is very clear that by 31st of December, as of today, there is no extension beyond 31st of December without consequences of again being blacklisted. Now, if I was OECD and if as a country I approach them on empathetic grounds, The first answer could be that, listen, the law came in April 2019. So we are talking about more than a year time given to the whole of country to fall back in shape. And hence, the more likely scenario is, even if there are few more weeks and days given for the notification extension or the actual compliance, you would end up needing that time rather than waiting for it to pass by. So the sooner you start, you will be in a position to submit in time. We do not expect, as of today, huge amount of leeway being given to UAE, which has always been on the losing end of the negotiations with the Code of Conduct Committee. So the blacklisting also happened more than 3 times because they could not really get hold of things. Again, there was a learning curve. So very, very brief extensions are possible, but beyond 31st of December, unlikely.
Okay, so Anuj, due to paucity of time, we will only take one more question, maybe and possibly if time permits one more. The next question is that it's a very generic point. Do all entities in the UAE need to undertake an assessment of impact of this regulation? And a related question is there is any threshold prescribed on applicability of ESR like we have in CBCR or VAT legislation?
The quick answer is no. No revenue threshold, no exceptions other than government entities. And hence, for the slide which is currently on everybody's screen, the phase 1 of the exercise will have to be undertaken by every UAE entity, give or take, in order to ensure that even if it is a partial compliance or you are partially exposed to these regulations, you end up filing the notifications correctly.
Okay, wonderful. Anuj will take one more last question. We have 2 more minutes to end this webinar. The last question and remaining will answer separately. We have couple of companies in FZE and mainland shares are held by Singapore entity, which is held by Indian entity again, and ultimately held by Indian individuals. The UAE companies are into software development. Will ESR apply to UAE entity?
So I hope we do appreciate that software development could mean different on different days. But if I just, for the reasons of answering this question, treat it like a service function, then again, the first question is why you should not fall under the service definition. If you find the reasons that either there is no revenue generation happening, or this it's not really a service but you are a cost center or something, then you start getting away out out of the scope. At the same time, if you start finding the answers are yes and yes and yes, that means yes, oh yes, I'm providing some sort of service, I'm making some sort of revenue. Again, the revenue is in UAE, it is missing taxation in Singapore and India, plus maybe you are cross charging something, I don't know, to Singapore, which is they're taking a tax break. So again, a multi-dimensional analysis, taking all these data points together, you will either fall within the scope or you will be able to at least meaningfully and for the right reasons take a position that hence proved I do not fall under the service definition.
Okay, I think we've reached to the end of webinar time schedule. Unanswered question will be responded on a one-on-one basis to the participant. Thank you, everybody. Over to Anjali to close this webinar.
Thank you, all the speakers. Thank you, all the participants. We'll end the session.